I learned that life is not just a destination, but a journey. While the expedition can be long and arduous, it can be full of beauty and pleasure as well.
The United States is currently trying to change the rules in the gold and cryptocurrency markets. Remember their debt, $35 trillion. Essentially, these are two alternatives to the currency segment of the global markets. Washington's actions in this direction clearly demonstrate one of the main American objectives. They are keen to solve the problem of declining confidence in the dollar. The U.S., just as it was in the 30s and 70s, will solve its financial problems at the expense of the entire world by driving everyone into the crypto cloud. Over time, when part of the U.S. national debt is placed in stablecoins, the U.S. will devalue this debt. Let me repeat that in simple terms. They currently have a $35 trillion debt. They are driving it into the crypto cloud, devaluing it, and starting from scratch. This is for those who are really into crypto.
Russia has been calling out the United States for overprinting money, for going too far into debt. It is the fall of a great empire, and Vladimir Putin has talked about the United States losing the reserve status of the US dollar. So there's nothing new about this. The only thing that's even remotely new is the stablecoin vision behind all of this. Instead of the banking system creating money, it's going to be the US Treasury that creates money. Instead of private infrastructure behind walled gardens, you're going to have open infrastructure that is open for everybody to use. Recently, the Ledger CEO announced that there was a large-scale attack happening to NPM packages, and this is the back end of a lot of crypto wallets, and it all stemmed through a phishing attack. Cybersecurity is a must, and this is why I decided to work with NordVPN. NordVPN is a sponsor of this show. Nord will help you avoid landing on dangerous websites, emails, and this is done through Threat Protection Pro. With just one click, you can protect your entire PC or device. The developer that was a victim of the phishing scam was a developer. He's tech savvy, and it still happens to the best of us. It is wise to have protection. Nord runs in the background using minimal resources, and this is an exclusive offer to my audience. You'll get 4 extra months when you use the link nordvpn.com/Darren. It's risk-free and has a 30-day money-back guarantee. So check them out at nordvpn.com/Darren.
Kinds of things the Trump administration is talking about. And so one of the most influential advisors in the White House right now is Stephen Moran. He's an economist, but he wrote a paper last November on basically reconfiguring the entire global trading system, pretty big claim. In there, he calls for something called the Mar-a-Lago Accord. And by the way, that was the title of chapter 6 of my book Aftermath, which came out in 2019, last time I was in Australia. So I'll take credit for coming up with the name. But his version of the Mar-a-Lago Accord looks at tariffs, trade, and exchange rate values, and kind of getting to your question, Jordan, about the Aussie dollar. Now, let's say I put 20% tariff on it. I'm the United States, and I put a 20% tariff on a trading partner. So some goods are, let's just say 100, it could be 100 million or whatever, but 100 as a measure, and I throw a 20% tariff on it. Now it's 120. But what if the trading partner devalues its currency by 15%? So it was at par, let's say hypothetically, and you drop it from 100 to 100 down to 85 to 100. Well, that negates the impact of the tariff because, yes, the tariff marks up the price, but if you're the producer and you can lower your local currency costs, your labor costs and so forth by devaluing your currency, you dilute the impact of the tariff. So what he is saying, and indirectly what the White House is saying to U.S. trading partners is, we're going to put these tariffs on, so that's a given, but don't you dare devalue your currency.
Sure.
We're going to devalue the dollar. And any trading partner that tries to offset the tariffs by devaluing its currencies, there are going to be consequences to that.
During the first Trump administration, we saw the application of tariffs, but we saw China and other countries devalue their currency to negate the tariffs. This time around, they're going to punish countries that devalue their currencies, but also the United States plans to devalue the dollar. And when they devalue the dollar, it's going to push up assets. It's going to push up the prices of all assets priced in dollars. And with this tokenized system, it is going to allow the U.S. Treasury to print even more debt. You see, money creation comes from the banking system, and with a tokenized system, the U.S. Treasury has direct influence on the money supply.
They said we're going to divide U.S. trading partners into three categories. So green, you're a friend, you work with us, we've negotiated the tariffs, you accept the tariffs, and you accept the fact that we're going to devalue the dollar. Yellow, you're okay, you're not an enemy, but you're not our best friend, and you may suffer higher tariffs. Red, you're an adversary, clearly China and Russia. I think it's a mistake with Russia, but China and Russia would be in that category. You're going to get tariffs, if not sanctions, et cetera. But in addition, this is where it gets tricky. He injects national security considerations. It's like, wait a second, this guy's, an economic advisor, maybe a Fed governor, but what's he doing talking about national security? Sounds like Henry Kissinger. But he said, if you're in the green category, you will get the benefit of U.S. military protection. Sure. You'll get the nuclear umbrella and more. If you're yellow, we may work with you. And if you're red, you can expect that we'll be in an adversarial position. So the significance of that is he's putting military might and security guarantees behind his claims about the U.S. dollar and exchange rates. Now, that's only been done twice in U.S. history. One was between 1971 and 1974 when Richard Nixon closed the gold window. It suspended the ability of foreign trading partners to redeem dollars for gold. The second time this was done where the goal was to devalue the dollar was 1985. James Baker was Secretary of the Treasury. Ronald Reagan was president. But this Baker really took the lead on this. And using some of these indices I mentioned, the dollar was at an all-time high, and Baker said, no, it's not good enough. We have to devalue the dollar. So the dollar dropped about between 15 and 20%, depending on the cross rate at the time. So here's the third instance of the U.S. engineering a devalued dollar. This isn't the markets doing this. This is the U.S. Treasury insisting on it.
The Fed and Treasury are separate, and the reason the Fed is a private entity is to check and balance the Treasury. But some of the duties of the Fed is to print physical cash, so IOU notes, plus it's also for reserves within the banking system. Stable coins are tokenized treasuries, so this is debt from the U.S. Treasury being tokenized and put onto a blockchain. This is replacing cash. The U.S. banking system will no longer have the same role, so reserves in a system like this are ambiguous at best. We're seeing Trump put a ton of pressure on the Fed and call the Federal Reserve into question. But also, we saw that the jobs numbers have been revised drastically.
Jobs mirage, a massive downward revision of job growth over the last year. 911,000 fewer jobs than originally reported. That is not a rounding error. That is a whiff of epic proportions. Can you smell the stench? We were told the economy was booming before President Trump took office. Turns out that was a lie. Washington bureaucrats inflated the numbers. The media ran with it. The Federal Reserve ran with it. Voters were told everything just fine.
So it's official. The official data that comes out of the White House, that comes out of the Federal Reserve is fraudulent. We're living off of lies. The economy is running off of lies. This is confidence in the system that is being eroded. The Fed has dual mandates of inflation and jobs. So the fact that this number is much lower, the Fed should lower interest rates. The stock market is at all-time highs. So lowering interest rates at all-time highs is going to push up the stock market and asset prices enormously.
The Fed says they're data dependent and the data has been atrocious, then it seems like there's probably some makeup cuts in order here, or the size of this month's cut needs to be recalibrated. And sure, it can be fixed. Anything can be fixed. You just have to first, we had to establish that it was broken, which President Trump did. Now we have to go about fixing it. And it wasn't working well before that. Kind of this lazy notion that they had dropped down to these low response rates, 30, 40% response rates, and they intuited the balance. Intuiting the balance is going from quantitative to qualitative. We need good empirical data, and it's not easy to get to, but you got to want to get there, and we want to get there. I think EJ is a great person to do it. I've known him for years. He's high integrity, data-driven, the ruthless truth pursuer.
The Federal Reserve is a private entity, and this is for a reason. It's for checks and balances with the Treasury. So the fact that Scott Bessent is trying to influence the Fed by putting in his own people into the Federal Reserve is all you need to hear. But this was happening way before Trump. Look at Janet Yellen. She went from the Treasury to the Fed. This is supposed to be independence. It's not supposed to be commingling of people within both institutions. They are questioning the Federal Reserve's data. They're questioning the institution itself. They're questioning the governors that sit on the Fed board. At the same time, stable coins reduce the role of the Federal Reserve and give the powers to the Treasury. The Treasury is going to oversee the fintechs that tokenize debt. All the transactions will be on chain, so KYC, AML is also a Treasury function.
The big issue coming are the Basel III rules, which are going to be re-proposed, hopefully by year end. And they're going to be re-proposed with the new seated regulators. So I think that is the real focal point. And I think what you're going to find is the industry has plenty of capital. The prior response had been whenever there's a problem anywhere, hit the banks with more capital. While that happened, their profitability on capital waned, as well as they lost market share to non-banks. I think there's plenty of trapped capital in these banks, and that's part of the bull story. I think if we get capital rules that are just similar to the prior capital rules, maybe even a little bit stiffer, that will release a lot of capital in the big banks. And I think that's another part of the bull story. And also, I don't think that makes the industry any less safe. I hope that this administration pivots to regulating a bank for the type of bank it is, not just saying banks of this size are all treated equal.
Right. You can't have a brushstroke for all these banks.
And the prior administration dropped the rate to $100 billion for much more stringent regulation. And guess what? When they do that, no banks cross $100 billion and they stop growing, which is bad for the economy.
Yep.
Hopefully we get away from that $100 billion number and the regulators pivot and they focused on regulating banks for the type of activities they do.
Let's talk about.
He sounds like Brad Garlinghouse from Ripple quoting trapped capital, but let's dissect this a little bit further. The Basel III requirements are the regulations for banks and large institutions within the banking system. So there is this trend of deregulation, which is not specific to the banking system. It's in every industry. And the banks have these regulations in place from the 2008 financial crisis. The larger banks were strapped down from what they can do, the riskier behavior. Now, the market is at all-time highs. It looks like the Fed is about to lower interest rates while the market's at all-time highs, leading into a speculation frenzy. Not to mention you're going to have 24/7 markets, tokenization, crypto within the stock market, home equity within the tokenization market, everything you can imagine. So the banks being deregulated at this moment in time is uncanny timing.
Why I think it's the best investment environment, you have a couple of things taking place all at once. Technology's changing. We've got incredible earnings growth at a number of tech companies. That's exciting. You've got bifurcation across different companies. In the fixed income market, you've got income everywhere. You can still create 6% income until the Fed cuts rates. That's super exciting in different areas. You've got publics, you've got privates, you've got gold, you've got Bitcoin. There's so much to do that it's the best I've ever seen in terms of figuring out where it is. And that to be an investor is as exciting as I've ever seen.
Did you just say that those opportunities exist in fixed income until the Fed cuts rates? Because that's going to happen next week, isn't it?
So
by the way, they're going to cut next week?
Yeah, they're going to cut. I think they should cut 50. They're going to cut 25, probably. It will depend. The CPI report that's out tomorrow will be or Thursday will be interesting. Listen, I think they should go 50, but I think they're going to go 25, and then we're going to start moving rate down.
This is BlackRock's Rick Ryder, and he is leaking to you the Federal Reserve's plan. The next time that they have their meeting, they're going to lower interest rates by 25, 50 basis points. This should send the markets flying. Instead of the banking system being in control of the money supply through loans, you're going to have the U.S. Treasury in charge of the money supply. And as they borrow money into existence, it just gets minted into stable coins. Stable coins will have whole ecosystems of investments like tokenized equities to invest in. Payment providers will have stablecoin integration, so this will fulfill the plan of a completely cashless society without central bank digital currencies. It will also funnel all of the world's wealth into the U.S. markets. All over the globe, countries have sovereign wealth funds, and these sovereign wealth funds invest in the U.S. market. So this is managing the retirement of all of their citizens, and this is being pushed into the U.S. market. This is a strategy that will only last one time. After they devalue the debt, there's going to be an exodus into neutral assets. This quite literally is the reset. It's a reset into a tokenized crypto-based system.
A key priority of my chairmanship is to allow market participants to innovate with super apps. I'm often asked, what do you mean by a super app? Plain and simple, securities intermediaries should be able to offer a broad range of products and services under one roof with a single license. A broker-dealer with an alternative trading system should be able to offer trading in non-security crypto assets alongside crypto asset securities, traditional securities, and other services without requiring 50-plus state licenses or multiple federal licenses. I've directed the commission staff to develop further guidance and rule proposals, ultimately to make this super app vision a reality.
The rules and regulations align with some sort of reset that takes place, but also Russia, Putin, they've talked about this since 2012, 2008. This is nothing new. So everybody was watching this take place, and there was really no actions happening. If you think about the timing for everything, this has been uncanny timing with bipartisan support. God's timing is always perfect. Trust his delays. He's got you. Thanks, everyone. I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy content like this, please consider joining my Patreon.